If you are over 55 years of age, these 3 mistakes will destroy your retirement faster than any market crash. And most advisors are not going to tell you about this. For those of you who don't know me, I'm the founder of Crown Haven, one of the nation's most respected retirement planning firms. I am the creator of the Retire Shield planning process, which we obviously deploy here at Crown Haven, but we also deliver to hundreds of advisory offices nationwide so they can replicate our process. I have sat across from billionaires talking about the incentives. I've walked the trading floors. I've spoken on stages in front of literally thousands of advisors, training them how to do this. I founded other companies, Bull Bear and Pinecone, Annuity Lock. I'm here to tell you the truth the industry will not tell you. I've helped families over the last 15 years navigate retirement, which is the most dangerous phase of your wealth, really the decade before and after you retire. And the reason I built my companies was I watched my widowed mother get failed by a system that profits over people who don't know better. Subscribe, share, follow me, because I'm going to show you how to avoid the traps that wipe out retirements every day. And people come into our offices for us to clean up this mess. Let's talk about the 3 mistakes you can't afford to make. One lie that I hear repeated so often it's nauseating is an advisor will tell a client, "You've saved enough. You're safe. You're good. You won the game, man." It's a lie, and it's a dangerous one, because retirement is not about how much you have saved. It's about whether or not your plan can survive volatility, inflation, rising costs, longer lifespans, medical shocks, tax regime changes, and market corrections. Most retirements fail not from a lack of money, but from a lack of structure, because here's the deal. The functional utility of your money, what you're actually going to use your money for, depends on the structure of the underlying plan design. And there are things you can control and there are things you can't. You can control the structure. You can't control monetary policy, inflation, taxation, etc. A market crash. So if you're paying somebody 1.25% or 1% or 0.7% or whatever to have the same portfolio you could get if you opened up an account on your own and bought index funds, and as a result of that, your maximum drawdown is 35 to 50% of your entire net wealth in an account that you're going to be drawing on in order to supplement your income to maintain your standard of living, while real inflation, due to quantitative easing and a whole other lot of issues that I've spoken to in other videos, will be 3 to 6% over the next decade. You are not set up, dude. You're not set up well, okay? So mistake number 1, I just spoke to it, keeping too much of your money exposed to market risk and volatility. If you're within 10 years of retirement, a major market crash is catastrophic for you. It just is. Why? Sequence of returns risk. This sounds complicated. It's not complicated. It's the #1 retirement killer out there. And basically what it is if you lose 30 to 40% early in retirement, you don't recover. The math says you don't recover. Why? If you lose 30%, you need a 43% gain to get back to even. If you have $100 and you lose 30%, you're down to 70. If you gain 30% on $70, where are you at? 91. So you need a 43% gain to get back to even. That's assuming you're just letting it go. You're letting it run. But in retirement, you're not letting it run. You're withdrawing from your funds. Now, if you combine that with the fact that the average return in the market over the past 100 years is about 10%, even if you were letting it run, it would take 4.3 years for you to get back to even. But that's not what happens, because you're taking a withdrawal. And if it's a typical withdrawal that an advisor would have you take of 3 to 4%, well, then it takes a long time to get back to even. And if another drawdown occurs, even 20%. After that initial drawdown, you're toast. This is not emotional. This is math. It's the single biggest mistake Americans over 55 make with regard to their retirement plan, and it's because their advisor does not show them the worst case outcome, because they are concerned with retaining the account. So they show them a Monte Carlo analysis saying, hey, you're going to make it. They don't show them what a black swan event looks like. They don't show them what real inflation will do to their purchasing power. They don't show them 3.1%, the 105-year average of inflation. They don't show them what a 2008 style crash would do to their portfolio, 2009. They don't show them what 2020 would do if they were taking the income, or 2022 for that matter. They don't do that. As a result, you are uninformed. Most people I talk to, and they are smart people, man. These are folks that I could list off their CVs. I've got like county commissioners. I've got like partners at law firms. I've got high-level engineers. I've got people that put in infrastructure for like major defense companies. I've got like pharmaceutical heads. I got everybody as clients, okay? They're smart people. They don't even know what their expense ratios are in their mutual funds. They were told they were nothing. We do a diagnostic. Oh, it's 0.89% on top of the fee you're paying. Oh, shit. And they've been told by their advisor or by some dude marketing, not, mistake number 2, to create a guaranteed income floor. Because I don't know why. I guess men are like, I'm strong enough to handle the markets. I've been accumulating for a really long time, so I'm going to keep doing that. Why would I want to create a pension for myself that replaces my need to worry about whether or not this stock is up or down? It's like, dude, or I'm wealthy enough and I don't need it. It's like, dude, if you're not ultra wealthy, and I'm talking ultra wealthy, because here's the thing, you're going to have things you want to do in retirement. You don't even know it yet because you're not there. Maybe you know some of those things. Maybe you'd never made the trip to Rome with your wife that you were gonna take, or maybe you did it for your honeymoon and you want to go back. Maybe that's one idea. Maybe your kids don't have kids yet, but they're sprawled out across the country. So that means a lot of tickets, and maybe you're like 6'3" like I am, so like coach kind of sucks for you. So you've got to do first class every time you go somewhere just for the legroom. You're gonna spend money, dude. So the question becomes, why on earth would you want the amount of money that you know is necessary? I don't care if you got $5 million, $6 million, $10 million. I got clients with $15 million that have done this. They built out a guaranteed income floor for themselves. Why? They're smart. Because if they know they're going to spend $300,000 a year on stuff, they want that to be inflation protected and not linked to what the market's going to do. And that allows them to go hang out, wherever they want to go hang out, in Paris, and not worry, and play golf in Scotland, and not worry about whether or not this particular pharmaceutical giant just lost 20% because of an earnings miss. That income protection is everything. It's longevity protection for your spouse. It's volatility insulation. And it's cash flow certainty. There is nothing better you can do for your peace of mind. It has to function. Your retirement plan has to function even when the market doesn't. And the only reason people don't do this is it's like ego or lack of information, or they have an advisor with an ignorance problem, or they think they're too wealthy for it, when in fact, most major institutions place insurance wrappers around their own holdings. So in fact, the wealthiest people, just the people you don't know, but the wealthiest people actually do this because they know the power of zero. Now, another reason people won't do this is because they're rightfully concerned about inflation. And this is a mistake I see people make, underestimating inflation. But you can have both. Don't underestimate, and I'm going to get to how you can do this, but don't underestimate inflation and healthcare costs, because this is where retirements quietly die, okay? Inflation is going to double your cost of living over a normal retirement span. It's probably going to more than double it with where we're headed. Healthcare costs alone, let's say you're 65, both you and your spouse, and you've had no major healthcare issues, maybe some high blood pressure or whatever, but no major healthcare issues. You both hit 65. There is a 91% chance that one of you is going to need some sort of care. So the question becomes, can you self-fund it? Do you have a plan in place to do it? Because there's a huge proportion of the population over here that's Medicaid is supposed to help, which that's not cool. I don't know if anybody's ever seen that play out. It's not cool. There's a really tiny fraction of the population over here that is so wealthy that it doesn't even hurt them, and then everybody else is in the middle. If you're in the middle, you need a plan. And if it doesn't account for medical inflation, long-term healthcare is literally a financial earthquake. You don't want the Sophie's choice of, is my wife's standard of living going to decline while she's sitting there at a bedside chair looking at you going, is he going to get the quality of care he deserves? You don't want that. I've seen it. You don't want that. I thank God every day that we protected my family from that. My stepfather had a hemorrhagic stroke when he was 82 years old, and he had a long-term healthcare plan that paid out 13 grand a month, and we didn't have to make that choice. Thank God, because he was smart. But if your plan doesn't account for inflation, cost of living acceleration, taxes on your Social Security, rising Medicare premiums, which is gonna happen, how that all relates to IRMA, prescription prices, assisted living. Your plan is a fragile plan. And combined with the market risk problem that I described earlier, combined with the sequence of returns risk problem that I described earlier, man, people don't run out of money because of spending. They run out of money because life gets more expensive. So what do you do right now? You build out a protected income floor. It deserves a seat at the table. This is mandatory. This isn't optional. And it doesn't make you weak. You're not waving a white flag of surrender. Look, I'm 38 years old. And I have this tool in my toolbox as a bond replacement for my portfolio that grows tax deferred at an average rate of 7% annually, which I'm totally fine with. And it represents like 30% of my portfolio. And it's killing it. It serves as a structured, safe bond replacement without interest rate risk, the reinvestment risk that goes along with that, any market risk, and it's growing tax deferred. And if I die, it goes probate protected to my wife. Now I've got liquidity over here and I've got optionality over here. My compounded annual growth rate, geometric average, volatility considered, is over 11%. What's important is my max drawdown. This is not my client's portfolios. This is one that I designed for myself. What's most important is I've made sure my max portfolio drawdown, the maximum potential loss that I can experience in any scenario, is less than 15%. That's insane. To be able to average 11% and your maximum possible drawdown is 15%, it's insane in a financial crisis type scenario. But I've done that. You think I sleep well at night? We do that for our clients all day long, okay? And how we do it is we separate the income bucket from the growth bucket, and we separate the growth bucket from the liquidity bucket. And the growth bucket must insulate you from volatility by using inflation-resistant assets, not just traditional bonds and traditional equities. Real assets. There is an investable asset class beyond domestic stocks. Now, I'm not saying you get rid of domestic stocks. They can be awesome, but the world is different than it was 10 years ago. You want optionality. Then you got to rehearse your worst case scenarios. You should know what happens if markets crash like I do. You should know what happens if inflation spikes. You should know what happens if taxes rise. You should know what happens if healthcare doubles. You should know how your portfolio performs across 4 different quadrants of inflation and growth. High growth, high inflation, low growth, low inflation, high growth, low inflation, low growth, high inflation. How does it do? What's your max drawdown in each scenario? How does it support your lifestyle? Because people that come in here that I do diagnostics on their portfolio, I'll tell you what, their advisors are expecting high growth, low inflation across the board. And that's what they're basing their retirement plan on. The Goldilocks scenario. We know how that story ends. This is not an Enya video, it's the real world. And then always maintain a liquidity bucket, man. Both to avoid forced withdrawals in downturns, but also to have dry powder to take advantage of capitulation selling, forced sellers, distressed sellers. This is the Pareto distribution in the real world. We're all playing one big game of Monopoly. Buy Boardwalk from the guy who's selling it at a discount. Don't land on Boardwalk when he's got 4 hotels on it. In order to do that, have the dry powder. This is your checklist. Avoid sequence of returns risk. If you don't know what that does to your portfolio, get a portfolio diagnostic from somebody who's actually going to show you this. If your current advisor won't do it, get a new advisor. Establish a protected income floor. Do that with a holistic advisory firm. Don't buy an annuity from a steak dinner annuity pitchman, okay? Because he's never going to talk to you again, most likely. Correct your inflation assumptions, because they're not going to be 2%. Model out your healthcare costs accurately. Make your growth bucket separate from your income bucket. Separate liquidity aside. Make sure you're accounting for all forms and sources of taxation, and ensure as a result of this that your plan is built for volatility. Retirement does not reward the hopeful. It rewards the prepared. I hope this was helpful for you. Subscribe, like, share it with somebody that needs to hear it. I often find that there's a quiet spouse in the household. This is for the quiet spouses, man. There's always somebody who talks a lot. I talk a lot. There's a quiet spouse that's been quietly watching as things have been kind of working for the past 3 or 4 years, but has these concerns. Show it to the spouse. This is not false narrative. This is truth. This is 60,000 hours of experience talking. This is people coming into me going, oh my God, I had this and now I have this, and how am I going to make it work? Through multiple different market cycles, multiple administrations, multiple tax regimes. It's real world experience. Use it. You deserve to know what I know. I want to pass my wisdom on to you. I want you to know everything I know. Until then, be good to each other. Be truthful. That's all we have in this world. Integrity. It's everything.